Good morning. Welcome back to Market Monday. Well, there's no doubt bear markets cause pain, and judging by some of the pain folks out there are experiencing, the bear of 2022 is certainly delivering. Bear markets cause pain in two ways: in price, when we see portfolio values decline, and in time, which doesn't get as much attention as price. See, with time, bear markets wear us out. With each bear market rally that turns out not to be a new bull market, it just fades down into new lows. Our hope is extinguished. Rinse and repeat a few times, and it's only human nature to grow frustrated and feel completely defeated.
And not just a bear market in stocks, our main diversifier, bonds, have utterly disappointed this year in terms of providing some relief from a falling stock market, and have actually contributed to the nauseating bear market, both in terms of price and time. We can see here that for the first time ever, 95% of both stock and bond ETFs, or exchange traded funds, are negative over a 12-month period. Compare that to 2008, where 100% of stock ETFs were negative over a 12-month period. But look at bonds. Less than 30% of bond ETFs were negative over that same 12-month period. So despite a 50% drawdown in stocks during 2008, at least bonds did provide that ballast we use them for.
While 2022 has been no laughing matter, we think this cartoon sums up the bond market pretty well. The punchline here being 30-year paper, another term for long-term bonds. Again, look at the sell-off in long-term treasuries, down over 30% just this year alone. You can consider yourself a conservative investor, buying long-term US treasuries, which are considered a risk-free asset with zero stock market exposure, and you would still be down over 30%.
In a similar vein, millions of folks out there faithfully invested in target date funds, which claim to move you into a more conservative allocation the closer you get to retirement. Only to find out those folks who retired 2 years ago in the Vanguard 2020 target date fund are down over 18% this year alone, wiping out almost 1/5 of its value.
Even the stock market's reaction to Fed rate hikes during the bear of 22 is certainly unusual. See, in the past 2 decades, the playbook has been for the stock market to eventually increase during Fed hiking cycles after an initial knee-jerk sell-off. You heard that right. You can see right here that the stock market generally rose along with the Fed rate hikes this century. The current stock market reaction is more reminiscent of the 1970s, where we saw increasing drawdowns along with the Fed hiking cycles. To be clear, we do not see 1970s style inflation ahead, and believe peak inflation is actually behind us.
With much of the world concerned the Fed is going to hike us into a recession, it's natural to be concerned about the market potentially heading lower. That is a possibility, but it's also not a guarantee. With markets having sold off in price anywhere from 25 to 35% for the indexes, and way more than that for some individual stocks, and in time from 10 months to over a year and a half, the bear of 22 has been a grinder for the history books.
So what is an investor to do? What do you do in the bear of 22? We'll be talking about this bear market in the next 3 years, 5 years, 10, 20, and 50 years into the future, I believe. When you look back and think, what did I do in the bear of 22? What do you want that to be? Good news, you can choose. Right now, each and every day until the end of the bear market. But what do I choose? Well, we can start by taking a look at the things that we can and can't control.
So what are some things we can control? Our savings and our spending rates, clarifying investing goals and the purpose for doing all this in the first place, the general allocation of your investments, those preferences are allowed to change from time to time, your tolerance for extended volatility and drawdowns. You're allowed to revisit those too. Did you tax loss harvest? Did you take your required minimum distribution by moving positions over rather than selling positions while they're down? You can do that. Did you take advantage of potentially lower capital gains this year and make a Roth conversion? Did you flip your dividends back to reinvest so they're buying at lower prices? Did you give? Yeah, 22 was tough, even brutal at times, but I still gave that year.
What about some things that we can't control? Fed interest rate decisions, war, shutdowns, the housing market and mortgage rates, the value of the US dollar, gas prices, inflation, the trajectory of the market. We want and wish and hope we could control them, but we can't. We'll play by those rules and fight as hard as we can, but if we can submit to that reality that these things are out of our control, it allows us to focus on those things that we can intensely.
We are here for you, and we're here with you. Hope you have a great week, and please do think to yourself, what did I do in the bear of 22?